urges India to boost financial sector reforms for Vision 2047. Background: the World Bank has released its latest financial sector assessment report on India. It says that if India wants to achieve its dream of becoming 30 trillion economy by 2047, this is where we dream of becoming a Viksit Bharat, it must continue and strengthen financial sector reforms. Currently, we are at 4 trillion. But, we are aiming to be 30 trillion by 2047, roughly 22 years from now. And we have to add another 26 trillion. So that can be added. That is not an impossible task, because see, you don't look at it कि भाई 4 trillion add करने में तो इतने साल लग गए. How can $26 trillion be added in such a less time? You should not forget the effect of compounding. When India did LPG reforms in 1991, India was a $273 billion economy. GDP of India was $273 billion. We touched the first trillion by 2007-8. We became a $1 trillion economy by 2007-8. We added the second trillion, means we became a $2 trillion economy by 2013-14. It took us 7 years only to add. Then from $2 to $3 trillion economy, it took us another 7-8 years. We can partly owe it to GST reforms in 2017 and COVID. But from $3 to $4 trillion economy, we reached in 4 to 5 years. So the time is reducing to add 1 trillion. And this is where, India's GDP can touch, because the time to add 1 trillion is reducing. This is the compounding effect. We should not forget. And every economy grows like this. But yes, it will not happen automatically. We'll have to do certain things. Lot of things. And one such thing which World Bank is recommending is financial sector reforms. The report says progress since 2017. India's financial system has become more resilient, means stronger, diversified, more variety is there, and inclusive, reaching more people compared to 2017. Reforms have helped India bounce back from economic challenges of the 2010s and COVID-19 pandemic. Banking and NBFCs, non-banking financial companies, World Bank praised India for expanding regulation over cooperative banks, tightening key prudential rules that ensure financial institutions stay safe and sound, no NPAs or reduced NPAs, reorganized regulatory departments to improve supervision, and it also appreciated India's scale-based regulation for NBFCs, meaning rules that vary based on size and type of NBFC. However, it recommended strengthening credit risk management, basically improving how banks and NBFCs handle loan risks. Capital markets like stock markets, bond markets and all. India's capital markets have grown from 144% of GDP in 2017 to 175% of its GDP now. Means our capital market is more than our GDP. This growth was supported by strong market infrastructure, a wide investor base, reforms like better collateral management, mutual fund rules, and sustainable investment frameworks. World Bank suggested new ideas to attract more capital, create credit enhancement mechanisms, set up risk sharing facilities, develop securitization platforms. These are the things which we have to do. Then oversight and investor protection. World Bank said India's securities and market oversight supervision is strong, and it is talking about SEBI over here. But it suggested a more integrated approach to monitor risks in mutual funds and stronger self-regulatory organizations to ensure fair practices. So these things should be there. About financial sector assessment program, what did the World Bank say? It is a joint program of the International Monetary Fund and World Bank, started in 1999, and it gives a comprehensive review of a country's financial sector, checking how stable and resilient it is. For India it is. How strong its regulation and supervision are. There are gaps which need to be filled, which the World Bank is suggesting. How well it can handle financial crisis. Now, by God's grace, financial crisis in the recent times have not impacted India, because there is a strong demand base, domestic demand, which is being generated by the huge population base. Why this matters? A strong and well-regulated financial sector is key for India's economic growth. By continuing reforms, India can mobilize more private capital, build investor confidence, stay on track towards its Vision 2047 goal of becoming a $30 trillion economy. And this is going to be very vital these financial sector reforms which India has to do. Banking, capital markets, and such like.